changing some stuff over here on my screen. Doing our third edition. Oh, that's Twitch playing in the background. Doing our third edition here of modeling match group. It should be the last one. I'm gonna start off our little music here too. Oh, not the. There we go. A little nice music in the background. Never hurt anyone. Modeling out match group right now should be the last time that we do match group. Third part. This will also start being the last, like the first one, the first YouTube series that I launch as well. So that should be a fun time. Just double checking everything real quick. So yeah, plan for today is just finish up match and do all the valuation stuff. So all of our different price targets, our free cash flow, IR, DCF, WAC, DCF, do the WAC, and do the discount multiples. Last time when I finished part 2, I got kind of tied up in the balance sheet, and I can go and reveal to you guys, just what I did there to go and fix that, because Match was producing a ton of cash. I had them, I think I kept debt the same, although I could change that right now if I really want to, because I still think they are, they're still producing 300,000. I think I may just go and have them pay down some debt as well. Yeah, why not? Pay down, let's do like 6% a year. Oop, that should be a negative. I did fix the balance sheet though, and I will show you that once I do this. Cool. Actually, no, let's not have them paid back debt, because I do a different methodology if I do that. I had them buying back some stock every year. Amount of free cash flow used, as you can see, it declines over time, but have them buying back about 1% of float every single year. Not terrible, not huge numbers there. How I fixed the balance sheet was one of the things in my cash flow statement was not calculating correctly, and I also went and put in some additional paid-in capital as well to go and make that all balance out and be nice and happy. So one of the things that I also noticed in my last video, this is the newest updated price, was that my reference here for shares outstanding was a little bit off. So instead of it being on that quarterly reference cell, it should be over here on our newest one. I should also just increase the zoom for you guys. If you guys can't see anything on here, please let me know. Please let me know if the music's too loud or anything like that too. That would be just awesome. Let me know in the chat. So yeah, all of these are linked to our different pricing methodologies with an average out. We'll do consensus EPS. We'll do our EPS first, and then do consensus EPS here in a sec. Always that always the diluted too. Oh, wrong tab. I can't go and just drag the formula across, so it always messes up the formatting. It always really bugs me whenever I can't, whenever I see that formatting, and I got this one completely wrong. That should be 68. Yeah, this one's probably going to be shorter. I'm debating whether or not I want to go and continue on tonight and do kind of me putting in the financials for SiriusXM. I was going to have a cheeky title for like doing it both in the same stream of like, IAC versus Liberty, and have like Malone and Barry Diller on as the picture, but I was like, probably not. Probably shouldn't go and do that. Just trying to figure out which view capture device, view account. Background color should be black. There we go. Actually, no. Font should be black. Sorry, I'm doing the view count thing. I just realized that no one can probably see how many viewers. There we go, 3, because it's a white Excel background. Yeah, but I went against that. I went against doing the whole Diller, the IAC thing, just because, I don't know, I think I may not go and do SiriusXM later today and just have that as be a separate stream. If this stream takes like an hour, I'll probably just call it that. That way it's not super long. You can see over here I was doing some SiriusXM stuff. I still need to get through a decent amount of data with that name. I'm going to use Atom Finance here to go and just do the peer analysis. Well, not the peer analysis, but the consensus EPS numbers. I think they only do it for 2 years. Just so I can go and look at what Wall Street is saying versus what I'm doing. I'm still pretty high compared to them, but you never know. Alright, so let's get back to doing our valuation methodologies. Oh, also, I did go and do the final 2 charts of EBIT margin and EBITDA margin, so those are all squared away. So we have all those set. Alright, first one is gonna be, actually I think I still have to set up WACC, yeah. Just to go and redo all these equity shares off of the calc versus when I originally had this model, it was with Bloomberg. I do want to say that is still correct. If I did that off of the 10K, should be correct. Risk-free rate is definitely not that. The 10-year is not that low. And I think the beta changed as well. Beta only at 55 times. Jeez. 10-year is trading at... This is why we go to Koifin. I could bring up my broker screen, but I'd rather not. Oh, there it is. 0.875%. Cool. Oh, that's shouldn't be calculating like that. Oh, that's why. Really low WACC, even though I am using 10% return. But yeah. If you guys have any questions or any things that you want to go and talk about throughout, please go ahead and use the chat for that. That's what it's there for. I guess the first and easiest one to go and do is our WACC DCF, standard WACC DCF here. You know, going and calculating EV essentially, discounting back through terminal growth rate, adding the net debt. Just have to check those cell references. It's probably not correct at all now that I think about it. Should be H73. Oh, that's correct. So, my F1 key. Terrible, terrible. Just gonna double check that real quick. $28, 228. Awesome, we're rolling. And shares outstanding. That should just be H instead. Cool. So all we gotta go and do, grab our free cash flow from our estimates, which we have kindly there at the bottom. Drag those over, and we should go and get our discount price. WACC is killing us here because it's so low. I'll probably just go and do, instead of 1%, and have 1% go up from there. That seems easier, and that seems like a extremely large number. should be calculating correctly. And it is, it's just an insanely large number because they don't have that much to add. But that's why I use an average. Price target, I forget what the free cash flow multiple was that we got earlier. I think it was like 10 times. When I looked up that should be correct. 188, yep. Cool, and then all this does is it looks at the cash flow growth rate, looks at your free cash flow multiple. It's a quick little discount thing right there. That's what you want to look at, not this. This was something else. So it's given us that's for a different methodology that I was doing back in the day. That should go in. Yep, okay, yeah. Gives us 5068, which is significantly below what that is. But if I go and tune up the free cash flow multiple to 15 times, you can see it gets you closer to what the actual price is, but I think 10 times was the mean. Our front page is already recalculated, showing us also what our appreciation potential is. So our IRR DCF. Now this is probably the one that probably is the most explaining, other than the free cash flow multiple, which is just a discounted free cash flow multiple. And I like to use discount multiples a lot, mainly because they kind of give you a second way of looking at everything versus just doing a DCF. Because you can tune DCFs up a lot of different ways, and you can this way too. But I like doing this kind of discounted free cash flow methodology. Just makes a lot of sense to me. This kind of methodology was taught to me at my previous employer, and I really, really like it because, again, the methodology to me seems very, very simple and very, very straightforward, as opposed to using a traditional DCF where you went in, like I did the WACC DCF, where you take your WACC and your terminal growth value are two separate things, kind of, and you discount them back by WACC, which can be super arbitrary to an extent. As you can see here, it's such a low number that, of course, you're going to go and get a higher stock price. Here, it's kind of what's your internal rate of return? Is it 10%? Is it 20%? Whatever. Then you can add or subtract things based on these kind of risk. So if you think there's high competitive risk, you can go and put in, a 1 right here and it'll add it on. Or if you think there's low competitive risk, add a 1 right there. A little bit subjective, but it kind of says, okay, here's your base return, how does that go and get altered? Like I said, you could go and have your base rate be 15% if, you think times are exuberant or whatever. It's kind of your opinion, but it's also your internal IRR. So for this one, we got our current debt tax rate, terminal growth value, 3%, current stock price, current shares outstanding, all that fun stuff. I just want to double check. Okay, yep. Because that should be dope. All right. Let's go and just start adding in our EBIT, I guess. If no one in the chat wants to say anything or what have you. This one I have not updated all the formatting on. Oh no. I think. Oh no, I did. I cleared out the formula when I cleaned this all up the other day. So I need to go and grab that, right? Oh no. I was thinking down below. I almost had a heart attack right there. I was like, oh no, did one of my formulas get not dragged? Okay. So typical just kind of growth formula right there. Taxes, takes all that out. Kind of add in our capex plus acquisitions. I didn't have them having any acquisitions, so just gonna go straight down to our little tab there, our little panel for capex. If I remember right, this should, yep. Depreciation, amortization. Instead of adding them both, I'll just go and do it from the cash flow statement. Oh no, yeah, I'm gonna have to go and add them both in. Alright, screw it. We'll just do depreciation plus amortization. Go and grab that, put all that in. Change our working cap. And all this is doing, of course, is calculating free cash flow. Minusing out your working cap, adding up all that, making sure all the signs are correct. Then this is just your number of years, and then this is what's discounting it back by our discount rate. Of course, just taking your terminal free cash flow, then discounting it back, and we go and we get our buy price, our sell price. We can go and see here kind of our sensitivity, which I'm actually more inclined to agree a little bit more with the sensitivity analysis here in the middle, of doing a 3.5 and probably upping this up. Maybe if I just go and add like a growth stability at a +1, just because I did kind of have a higher, some higher growth turned in, I may go and bump up that that discount rate a little bit. And yeah, we go and get sell price of 95, buy price of 76, and combined looking at 133. So it's looking half decent. Of course, I did kind of, like I said, juice some of those growth metrics a little bit. I'm more inclined to go and stick with the IRR DCF than probably the WACC or the free cash flow multiple, just to start, just off the bat. Just because the WACC DCF was brought down significantly by that super low WACC, given despite us using our expected return of 10%, the beta, which we got on Atom Finance. Let's just check what Koifin says about it. I'll be completely honest, I don't use Koifin that much for like stuff like this. So that's it actually doesn't even have the beta. Wow. Let's go do a sneak behind. Oh, I thought I still had my Merrill Lynch platform up. Let's do CNBC. I'm also just not going to run the regression to go and get the actual answer. Well, I can just Google on CNBC. I'm just not seeing it on here. Market cap, beta 0.55. All right, one last double check. That just is wild to me that Match has that low of a beta. FinViz. Just trying to find it. It's been a while since I've been on FinViz, to be honest. FinViz agrees. All right, so yeah, low. You got a mixture of low beta and a very, very, very low risk-free rate. So you're gonna go and have a lot lower whack. And also simply because I'm not that huge of a debt-ridden company. All right, going on to discount multiples. I want to go and say I did go and grab these multiples from doing Facebook, YY, Snap, IEC, and some others, so we can go through again if you guys want to on like how I would do this normally. So I do match, I do peer analysis. Do match, FB, Snap, YY because they're like the equivalent of like Tinder over in China. Snap because another high kind of tech name. IAC is their holding company, so it's kind of cheating to kind of do that, but might as well since they own it. I don't know what's another good thing to add on here. Like Snap's good because it's a mobile app. Bumble's private, Grindr's private, so there's really kind of tough comps here. But yeah, I guess we'll keep it at that. So PE, the mean, I have to go and delete Snap and YY for that, and Snap and IAC for that. Snap, IAC, mean of 32 times. I think I did 44 times. So we'll shift that over to 32.7 times. Keep, I was gonna say, I normally go down by 5 or 10 here, so we'll go and do. Yeah, thanks. Oh, Money Boss, thanks for the, thanks for joining in the chat. Yeah, there's no public comps, which makes it so tough to go and do. I could have just done, I guess, a tech mean. Yeah, closest I've agreed is Facebook. I like throwing YY in there because YY has that dating app, you know? So I'll go down by, let's just do 10 just for the shits and the giggles every year, just to see how big of an effect that has, and we can change it later on. Oh, Money Boss, since you're in the chat right now, tell me if you think the music is too loud or not. I have it like mixed into the video, then it's also coming through my speaker, so maybe being picked up by my mic. We'll go and do EV sales next time. Let's go and add back Snap into the mix. Wow, why selling down at, oh, thanks, appreciate that. Snap at 13 and wow, I'm surprised why was that low of an EV, EV to rev. That's shocking to me. Okay, mean of 8.6 times at 7.6 times. Going down by 1 turn every time, EV to EBITDA. Or EBITDA over share. It's because Snap doesn't have EV to EBITDA, which is weird. Now we'll call it 20 times. Make that a round robin type of thing. Alright. This is again just doing discount multiples, so taking our discount rate from our IRR DCF, taking our discount periods, doing their same upside that we are looking for throughout the other ones, and I'll just go and calculate I'll go and calculate that for us. I actually don't even need to calculate because I know I always do EPS. It's 2020. Well, I don't know why it's saying free cash flow per share, because because I had this on other one as well. Because the other company that was doing on this was free cash flow per share. 2020. Yeah, Money Boss. I don't know how long you've been watching the video, but I was thinking about just ending the video once I finish up this, just because I haven't finished the next stock yet, and I don't know like how fun it would be for people to just watch me input financials into a blank model, right? Something more like actionable, I think, would be more useful. EV to sales. 2020. All right, just going back to the income statement. This is gonna be fun because, well, actually I do have them changing every year, so. The reason why I also like doing these discount multiples is there a sanity check for me. You know, how crazy am I versus pure analysis and stuff like that. Well, CHK, well, they're going bankrupt, right? Aren't they? Didn't they announce today that they're going bankrupt? CHK is Chesapeake, right? No use in modeling a bankrupt company. Believe me, I've learned that from doing FTR. Because they're bankrupt as well. Did I see the price though for CHK? I did not. Let's whip up our Atom finance page real quick. If you guys don't use Atom, it's pretty dope. I have it up on one of my screens a lot. $31 and they just declared bankruptcy today? That's crazy. What? Cause that debt is a decent amount of their EV. Wrong coast, CHK. Oh, China Telecom, my bad. There we go. Oh yeah, it's spiked up today because they're declaring bankruptcy. It's $69. Well, 69. That's nice that they went bankrupt at that. But this is all you need to know, right here, right. Your EV value. If your debt is that much of your EV value, you're screwed. You're screwed. I just even want to look at their financials real quick. Oh, if you guys haven't used Atom, what's nice is like you can do these little model things where you can open a model or do a new little model, like a consensus, or like you can change stuff, but like total, Jesus Christ. Yeah, good luck with your 6 million in cash and equivalents if you're an equity holder getting absolutely anything at all. I mean, sure, they've got a lot in PP&E, but no other oil company is going to buy their assets at 100 cents on the dollar. You can automatically just probably slash that in half easily, and you're still in front of what was their debt load? You're still in for 9 billion. That's probably going to go and collect it all, plus some of their preferreds. Yeah, you're screwed. If you're a debt holder, you're screwed. I don't get why it went up. I have no idea why. And I know Hertz was the same thing. And I was chatting with this HTC. I was chatting. God, again, HT. Why is my Z not working? There we go. I was chatting with some of my friends in a macro chat today, and I was like, "What's going on with these bankrupt companies just going up by like 115%? It's just crazy because the equity's worthless. It's worthless. If you own Hertz shares, these are fun coupons at this point." I mean, it's even worse right here for your market value versus your EV. Now, I don't know all the rules for Chapter 11, but if you can in your management, why would you not try and do a secondary offering right now for shares? Just issue $1 billion of their stock at $1 and see if you can catch any bid to try and help pay off some of the debt. I don't know, use all the proceeds for paying off more of the debt. I don't know if you can do that, but I don't see why you wouldn't try if you could, especially with the way the stock's been trading. All right, got a little bit off topic. Got a little bit off topic there, but that was fun. My little rant about bankrupt companies. Okay, we did all that. You need to share. EBITDA over shares. Oop. Ooh, that's another good thing that I just now realized. If I went and connected the ending balance up to the shares outstanding up top. Oh, I did. Okay, good. For a second there, I thought I was gonna be screwed. I was gonna be like, oh man, was I that big of an idiot? Discount multiples. What I do for the revenue growth rates, I kind of modeled some stuff out off of prior with, I'll show you here in a sec once I'm done with this. Just so I'm keeping my head all straight. And I zoomed it in because earlier when no one was talking in the chat for the previous videos, no one was saying whether or not they could see anything. What I pretty much did was I built the revenue growth almost entirely off of doing an ARPU based rev model and growing ARPU. Growing ARPU based on kind of previous growth years and kind of scaling it back down, with the main theory being North America slows down, but international grows as it becomes a bigger, substantial portion of both subs and higher monetization over in the internationally speaking. Because I think a core part of my thesis is that Match grows more. Match becomes more and more international focus versus just straight US. I mean, you can go and look at the Tinder numbers alone about international share, and it's super high. So for rev, I just kind of went and did a pretty basic. The year-over-year numbers look really high because for some of them they are, but I just did a typical, ARPU kind of growth rate. It's times 400 because actually, thank you for catching that, because it should be times 300 for the conversion rate, not 400. So that probably changes things a decent amount, and I won't have huge swings. Thank you so much for asking that question, or else I would have kept it in there exactly like that, because I was an idiot when I first did that. Still a decent jump in rev, but except for international. But let's see how much that affects our. Pretty much says I may go and lower that IRR now because my rev assumptions seem a little bit better. Pretty much it says it's fairly valued IRR. So it's pretty much fairly valued. Discount multiples. We're going back to them. Say pretty rich. I mean, I could have juiced some of these up a little bit more instead of taking them down by 10 turns every single time. Or 1 turn. I could have done this as 8 times and 7.6 times. Makes a little bit of a difference, but not huge. So yeah, I guess the final verdict is Match Group is fairly valued here based on the assumptions that we laid out. Free cash flow multiple at 10 times. They could probably go up to 15 times. Let's recheck our peer analysis. I don't know why ads match every single time. It like double counts it. FBYY snap. Oh, I can't do free cash flow multiples on here, can I? EBITDA would be the closest one. Can I add? Cannot. Wow. That's a bummer. I don't know, let's see what happens if we do go and put it towards 15 times free cash flow. Bumps it up a little bit to 57 versus 38. I don't know, would you pay 15 times free cash flow per share for Match Group? Yeah, with that change of revenue, our EPS go way down as well. And still kind of the model says fairly valued. With most of that coming from the WACC DCF of WACC being so high. I mean so low right now. I don't know, maybe we tweak some of those ARPU growth rates then. Yeah, terminal year being that low is kind of whack. Like what happens if it's 5% for 2 years? Go back and look. Changed a little bit. Yeah, having rev growth in North America It's still significantly below like average GDP growth. I mean, that's like AT&T's like cheering if they can go and get 2% rev growth, but also don't know why I did that, because that should go and be as this is me being probably nervous for my first ever Twitch stream. So I don't know why I just wanted to put the year-over-year growth there, because I can just do the bloody formula. But you can kind of see the big middle hump. I don't know. Maybe bringing it down by 1% every year is a little rough on them. Finishing off of $1 in ARPU for international. Doesn't seem that unreasonable. Still barely moves the ending format, so I don't know, this would be probably the shortest live stream I've done yet, so yeah, I mean we did match. So I guess the next one will be SiriusXM. I'm gonna try and get that all finished out for the historicals the next time, which will be Wednesday when I stream. Monday, Wednesdays, of course, are me doing financial models. What'll also be fun is next week, next Monday, what we'll be going and doing also is Adobe reports. I don't know what is going on with my keyboard tonight. Adobe reports earnings next week. Well, actually, they report earnings on the 11th. But what I'm going to go and do for Adobe is I have a nice model for them. Save, in fact, file, save as. 3, this will be end. I gotta start getting in the habit of that. I do have a nice model for Adobe. And we will go and update this model together for Q2. I will not look at any of the Q2 numbers before the live stream. That way it's kind of like Billy but more extreme, where like I haven't planned out anything. I haven't looked at it at all. It'll just be me kind of like giving my raw thoughts on it, as well as I go through how I update this one, and going through like some surprises I see, all that, how I go and model all this out. I think that'll be a fun one to go and do, just because it's like my raw looking at it. You guys, if you guys haven't read any of the stuff, it'll be your first time looking at it too. That'll be fun. Like I said, hopefully next Wednesday, this Wednesday, I have all the SiriusXM financials done. I'm like on Q1 of 2016 right now, and I'm moving along pretty fast. I just started like last Thursday, and that's me altering all the stuff as well to make the model, to go and change out how the cash flow statement is and all that stuff like that, because they're completely different than like match. So that should be a fun one to go and start doing, because I'm gonna do SiriusXM. I'm also gonna do the Liberty Tracker on it in the same one, so that can be kind of a cool multi-part series where it's one series of us doing Sirius, one part of us doing Liberty SiriusXM, and then putting them all together and seeing what's the better way to go and invest in the name. So yeah, now that match is done, this will be on YouTube. This is going to be so much fun, because I do know for videos on Twitch they only have a 14-day backlog, so a lot of these videos will fade away if I don't put them on YouTube. But yeah, thanks everyone for tuning in this week. Short one, but thought it was good to go and keep it short and to cap off us finishing our first model together. And please join me next time. Like I said, Monday, Wednesdays I do financial models live streaming at 7 p.m. Central Time. Saturdays are of course us playing zombies together, doing a little Q&A and all that. Twitter is in the Twitch info page, so feel free to go and follow me on Twitter. I'll answer a lot more questions. I'm a lot more active on there. And I guess I'll see you guys next time.